Thank you, Ashley. Good evening, everybody. Welcome to CATAX's Capital Allowances webinar. As Ashley stated, my name is Nathan. I'm one of the Regional Development Directors here at CATAX, and speciality is the Capital Allowances arena, part of our wider estates team. So I just want to welcome you all tonight. Thanks for attending. I'll say hello to those of you that are attending later on via the recording. CATAX is a proud partner of NPA and has been since 2016, and we have assisted a number of members around capital allowances and research and development. So it's a partnership we're very, very proud to be part of. And tonight I'll just be giving you a whistle-stop tour around all things capital allowances. So really looking forward to sharing with CATAX. Next slide, please, Ashley. So what we will cover is who we are at CATAX, help you understand capital allowances tax relief in a bit more detail. It's a very, very broad subject, but it can be very simplistic as well. And also how we can work together moving forward and help the NPA members with regards to this meaningful tax relief. Next slide, please, Ashley. Understanding capital allowances, it can be tricky. Essentially, it's a statutory tax relief that's been around a long, long time, as early as the 1900s. And it's really born upon the identification of certain qualifying assets within a commercial building. As it mentions here, claims can be made against qualifying plant within commercial property subject to certain HMRC criteria, which has changed over the years. We've seen two really meaningful changes in the past decade or so, which has made it more complex and more of a specialist area. So as it mentions in the slide here, it is a specialist area. It's not an area that's consistently covered by accountants or law firms in relation to the purchase of a property. So it's really a space that we do an awful lot of good work with our clients. But I could talk about it all night, and we find that this short video that we're about to play just gives you a bit of a nutshell about what it's all about. So if you'd like to play the video, Ashley.
Did you know there could be money hiding in your commercial property? No? Well, there could be, and we'd like to help you find it. It's called Capital Allowances Tax Relief, and it's basically claiming back tax for all the embedded items in your building, from the lighting above your head and the heating system to the piping underground. It's pretty much anything in your building that would not fall out if you turned it upside down and shook it. We are the experts, so we know how to find the biggest claim possible. In fact, our average client tax benefit is in the thousands. With most things, there's usually a catch, but with CATAX, there isn't one. If we can't identify a benefit, you don't pay a penny, so there's no risk. We only need some basic details from you, and we'll do all the hard work. So if you're a UK taxpayer and you own your own commercial property, call us now and we'll quickly work out if you're eligible for capital allowance tax relief. The money belongs to you, so let's claim it back from the taxman now. CATAX, helping you uncover the hidden capital allowances relief inside your commercial property.
Thank you, Ashley. Next slide, please. So as the video mentioned, property owner, to qualify for capital allowances, the property must be owned by a UK tax-paying entity. It obviously must be a commercial property. We'll take a look at what those properties entail shortly. The list is long and varied, but the property must also have a qualifying activity happening. So what is a qualifying activity? That could be a limited company owns a building and operates its business out of that building, or similarly, a company's director owns the building personally and receives a rent back from the company as the landlord. So that's a qualifying criteria. The question we often get is around the residential element. So the property must be commercial. HMOs and things like that don't qualify. Apartment blocks can, but it's usually just down to the communal areas, so it does restrict things greatly. So we are really just focusing tonight on commercial properties. Next slide, please. So here's a bit of a taste of the types of properties that we see day to day, and as it says there, plus many more. There are many more, but where we typically find we do most of our work are in these properties. So anything ranging from offices, restaurants and pubs, warehouses, nurseries, care homes, hotels, you name it, we've done a claim for it. Next slide, please, Ashley. So the video mentioned about items that are embedded. Now, the word embedded doesn't actually appear in any of the legislation for capital allowances, but it's probably the best way to describe these items. So when you walk around any commercial building, it needs heating, usually, it needs lighting, it needs sanitary ware and water disposal to keep the place habitable. So these are often things that we find don't get visited as much as we'd like, either at acquisition point or if the landlord has owned the property a long time. These sorts of things are also available to not just property owners, but companies, entities, individuals who are leasing over a long-term period, and they're subject to a lease premium. So it doesn't just have to be landlords of commercial property, it can be leaseholders. And it's also available not just on acquisition, but also on fit outs, extensions, refurbishments. Next slide, Ashley. Obviously, with most things where there's eligibility, there is also non-eligibility. But in the world of capital allowances, we find this also represents a big opportunity to look at capital allowances in more detail. So if a property is owned by any of the entities you see on the screen here, they're already getting some form of tax relief in other ways. So charities, local authorities, governing bodies, pension schemes, and developers can't claim capital allowances. So any property that's about to be transferred into one of these, or either transferred out of one of these, does represent an opportunity to look at allowances. Property coming out of these, why? Well, because we know that the previous owner couldn't have claimed. Developers on their bottom right, you'll notice, that's because they typically hold commercial property as stock, not as a fixed asset. And we often see an awful lot of property going into pensions, purchased by pensions, but similarly coming out of pensions too. So that's a big opportunity to review the allowances position before it goes in or just after it comes out. Next slide, please, Ashley. So I thought it would be helpful to put some context into capital allowances and how real life claims happen. So what we've done here is we've taken a snapshot of a street that we did a claim for a little while ago. And as you can see there, it looks like a collection of shops, but it's actually one building that the client purchased. And the purchase price was somewhere in the region of 3 million for this. And the client rightly got quite excited about the prospect of allowances available here. But as you can see, the top 2 floors are residential. So the commercial space was literally limited to the one ground floor. So this is where what we call applying a reasonable apportionment to a claim comes in. It's what percentage of the entire framework of the building has a qualifying activity. And in this case, I think it was somewhere in the region of £1 million worth, about 3 million qualified for having plant and machinery that met HMRC criteria. We can sometimes look at the residential space up above, but like I said, it's just limited to communal space. And in this particular building, there was only 2 floors of residential, so that was pretty limited. So it did impact the claim. It did maybe bring it out a position where it wasn't quite what the client was expecting, given what they paid for the building. So I just wanted to sort of give you an idea there. We spoke about the types of property that we look at, and we're much better off when we're looking at properties where there is a 70, 80, 20, 70, 30 split in the commercial arena than the residential, because it does water down the claim somewhat. I'm happy to take questions on that at the end if that's not clear, but I thought giving you a street view visual of a claim we've done and how it impacted would help. Next slide, please, Ashley. I mentioned earlier on about legislation changes, and probably the biggest one that we've seen in the capital allowances world happened in 2014. And essentially, what it says is any property that's purchased after April 2014, which is obviously going to be everything now, is subject to what we call a pooling requirement. And it's basically a contract within a contract at purchase stage, where the vendor and the buyer have to agree on what has been done around capital allowances. And it's done via what we call a Section 198 election, which was part of the Capital Allowances Act 2001. And essentially it's an agreement between both parties in terms of what's been done thus far and what is open to the new buyer. And it's an area that's consistently right up there in terms of reasons why claims either are reduced, restricted, or don't happen at all. And the big issue we potentially have with this is that if capital allowances aren't correctly approached during the contract and the purchase, then we have a 2-year window to be able to go back and amend contracts and claims to get the right information listed. So it's vitally important that people that are buying commercial property seek expert advice either at negotiation stage or within that 2-year window. And as you can probably understand, it's a darn sight easier to do it when all parties are at the table, as opposed to 6-12 months down the line when everyone's gone their separate ways. So it is a particular area of challenge that we find, but one that is very easily remedied if we're involved during contract negotiations, because we can assist with contract clauses and advice in this area. Next slide, please, Ashley. The subject we also get asked often by accountants when they have clients looking to acquire property is whether to purchase it within a company or whether to purchase the company that owns the property, or whether just to purchase the property. And I just wanted to touch on this because it is very, very much topical and something that we see often. And there are obviously other issues at play other than capital allowances with this question. But with regardless, in terms of purchasing it via a company, it's not changing hands, essentially. So the accelerators that we sometimes see where a claim can be made 100% in year one via what we call annual investment allowance do not apply. So it has to be written down over time. This essentially just means it takes longer for the relief to come out the other end. And allowances are obviously based on the previous property purchase price held within the company, not the company value that you buy it for. Purchasing the property, as we mentioned in the previous slide, it's subject to 2014 legislation. So it stipulates that we have to ascertain what the previous owner could have done and had done. So the claim is still heavily based on what they paid for it. So if we have a client who has owned it since 2000 and paid 200,000 for it and is selling it for 500,000 now, a lot of the claim will be based on that previous 200,000 element, along with the 500 for our client, if needs be on the integral features side of it. But the good news is on this one is that it is changing hands. It is moving from one owner to another. So annual investment allowance at 100% in year one would mean an acceleration of the relief available to the new owner. So I hope that, obviously we can cover this off with questions at the end, but I just wanted to mention this because it is an area where tax advice collides with capital allowances, and it's another area where we do an awful lot of good work with accountants and property owners alike to make sure that it's not only bought the right way, but then owned the right way, because as you can see at the bottom, how it's owned will dictate how the tax relief works. So if you own it individually, the relief can be enjoyed up to 45%. If it's owned inside a company, corporation at the moment at 19%. Next slide, Ashley. So there we are. That's the end of the slide. I hope that was, like I said, a brief whistle-stop tour, but we just wanted to communicate the opportunities, the criteria, and the potential areas where more technical tax questions are asked, where it can affect the outcome of the advice we give. But as the video mentioned, we do operate very much on a no-win, no-fee basis. So we look to give clients benefit analysis and understanding of what they could be looking at before we look to engage. So it really is a no-brainer, a no-win, no-fee process we follow, because we want clients to understand first what is available before entering into any sort of agreement. So that's all from me, and I'll obviously happily hand over for any questions.
Thanks for that, Nathan. Yeah, we've had a few raised hands while people were speaking. So let me just go into the participants and see who we've got here. So now, would you like to unmute yourself and ask a question?
Thank you. In our situation, Nathan, we bought a property in 2014, and now we are into 2021. And we really don't know. I mean, after listening to you today, I really don't know whether this was applied for at the time. It's a 100% commercial property, the pharmacy premises that was bought and is rented to the company. Any chance, and how do we go about it if we have to find out? Do we stand a chance?
If it was 2014 but pre-April 1st or April the 6th,
no, December 2014. December.
It was December 2014. Okay, so straight away we are the unrestricted portion of any claim has probably fallen away. However, do you happen to, I'm happy to take this offline with you if you want to, but really my mind would go to if you are the first owner since 2008. Do you happen to know that?
No, we bought it from somebody who was the owner. So we are the second owner because we bought it in 2014. So there was a previous owner.
Mm-hmm. When did they buy it?
2000, I think 9 or something like that. 2008, 9.
If they purchased post,
they built it up. He built it up, and you know, obviously.
Happily look at this. Take this offline with you because essentially, if you are by chance the first owner since April 2008, then there may be a additional integral features claim that you can make. I don't want to get too in depth on this webinar, but there may be a slight top-up claim for you to make. But also, obviously, have you incurred any expenditure since you've owned it? Any major improvements or anything like that?
We have, yes, we made some improvements, and especially for air conditioner and stuff, and extended one of the rooms to make it into a consulting room.
Okay.
So yeah.
I mean, those costs are obviously capital expenditure costs borne by you since you've owned it. So they would certainly be something to look at as well. But I mean, actually, I don't know whether we can we take this offline, and I can obviously, I didn't catch your name either. Sorry.
Sunil.
Sunil, thank you. I can probably help. I can probably take this offline with you and just give you a bit more information.
Okay.
Yeah,
if you give me your number, then I can just.
So now what I'll do is I will email you Nathan's details tomorrow, and
Okay.
and copy in Nathan, so you can reach out to each other.
Thank you so much. Thank you. Thanks, Nathan. That was useful.
Thank you.
Nathan, we've had one person ask in the chat, does this apply to commercial properties that are being rented, or does it need to be owned by the claimant?
Yes, so capital allowances can be claimed by tenants or leaseholders, I should say, but it can get a bit grey, and we tend to look for leaseholders who are subject to a lease premium, so where a lease premium has been paid. If that is the case, then we can certainly look at doing something. If a lease premium, but that's on acquisition or embedded plant and machinery. If somebody leases a property and is a tenant and carries out items of extensions, refurbishment, fit outs, then that is still capital expenditure that they have spent. So it still does come under the qualifying of embedded plant and machinery if they have invested in lighting, electrics, data cabling, all these things that go into the skin of the building to help it work. Then there is still expenditure there that can be looked at. Now, sometimes it won't meet our criteria. And what I mean by that is it's not going to be a commercially viable exercise to do once you take into consideration the value of what's been done. But it's certainly something that can be raised by the accountant with the accountant, because they may have itemized expenditure that the accountant can identify easily and be able to break out for allowances purposes. And we've obviously seen in the budget recently about super deduction. So any brand new items of plant and machinery that are invested in between now and March 2023 does carry the super deduction. And I'm happy to pick up on this item separately with anybody that wants to know more. But essentially, the headline figure is 130% of the cost of the work is available in year one to claim back in allowances now. So it's really, we're delighted at Catax because it's really put capital allowances out there in the mainstream flow of information that's out there now, because historically capital allowances has been quite a muted area. So it's great to see it in the budget.
Okay, thanks. Next question we have is, if we lease a property and it has a flat above the pharmacy included in rent, can that improvements be recovered? Can improvements on that be recovered?
So so I think what that question is saying is if there's improvements to the flats above, can that be claimed if it's part of the rent? And the answer to that question would be no, because it's improvements that's being made to a part of the building that doesn't have qualifying activity going on. So that street view slide that I showed, those 2 floors above the shops, if anything was going on there to improve that space, that wouldn't qualify, apart from what we call the communal areas. So stairwells, landings, foyers, lifts, those sorts of things which are communal are fine, but the actual dwelling areas, the rooms, wouldn't qualify. So I think that's what the question is driving at.
And we have had a couple of questions asking, what is your typical fee?
That's a good question. It's why we do the benefit analysis ahead of time, because we want our clients to be obviously in a cash positive position, and sometimes it's just not possible. But typically our fees are, if we're dealing with a commercial property that's owned individually, we typically charge 7% of the allowances we uncover, not the tax relief, the allowances pool that we uncover. If it's property that's owned by a limited company, then it's 5% of the allowance pool that we uncover. So we have to identify allowances before we charge. So it's pretty much standard market percentages there, but obviously we negotiate if we have a portfolio or we have there are other extenuating circumstances, we can negotiate with clients. We want to help, but it's got to be commercially viable for all parties.
Okay, and a bit of a tricky one. Well, not really, but what would your company do different from what my accountant does?
Well, that's a good question.
Sorry, put you on the spot there.
So the accountant, I guess, in my simplistic mind, how we differ from accountants is that we're able to go and do a survey. We see we're not accountants. We make it very, very clear we don't get involved in what they do, but what we do we know is very specialist. So how do we differ? We know what we're looking for. An accountant sat behind a desk needs an invoice. They need something tangible to be able to say that's what that person has paid for it. So give an example. And as the video mentioned, you turn a building upside down, the things that would fall out, I would expect an accountant to be able to claim because there's an invoice, there's an attributed cost. But when you're buying a building, you're buying it for the purchase price. You're not buying it because of what's embedded in the walls or under the floors or the pipe work. So that's where we come into our own. And accountants, our biggest clients are accountancy firms because they understand that they may miss something or they may not challenge that election or that CPSE contract response properly. It's a specialist area. You often hear accountants talk about capital allowances, but it's very much on small items like cars and PC equipment, things like that. Only the top four, I'd say top three accountancy practices in the country have specialist capital allowance teams attributed to them.
Great, thanks. We've got another question. How will the capital allowance affect base cost of the property?
The capital allowance effect. I think what we're talking about here is CGT. We get a lot of concerns, historic concerns about capital allowances affecting capital gains. And the reality is that capital allowances have about as much to do with CGT as it does capital punishment. It's got nothing to do with it at all. There's actually lines in the legislation that strip this out specifically. The only time a property will be affected for CGT by any capital allowance claims made is if that property is sold at a loss. So as long as the property is sold for more than it was bought for, and the Section 198 election is correctly filled out to protect the vendor if they have made capital allowance claims, then there's really nothing to worry about.
Great. And I think we need to wrap it up, otherwise you'll be here all night asking for questions. I'm going to just give you two more. If anyone does have more questions, please just email the events@npa.co.uk and we will put you in touch with Nathan and the CatAx team. But the other question I have, and I'm not sure quite what it means, sorry, but it does your work deal with SDLT?
SDLT, stamp duty land tax, by any chance? If that is what it's saying, it may be. Did you say SD?
Yes, that's right. Yeah, stamp duty land tax.
Stamp duty land tax. Okay, yes. So we do find that is part of what we do. It's involved in what we do heavily. So we can advise on these areas. It's not our specialist area, but we have started working, partnering with somebody that specializes in this area. And it is really quite surprising just what can be done in this area by asking a few more questions in addition to what HMRC actually ask on their own calculator. So if there is anybody, obviously there is someone, they've asked the question, who wants to know more, then I'd be delighted to pick that up with them as a separate issue.
Great. And then unless we have any more burning questions coming through, the final one is, can any capital allowance become available if properties were purchased in 1987 and 1988 and extensively fitted?
Yes. The issue we find with those sort of dates that we've just spoken about is it can sometimes be difficult to prove purchase. So if there's contracts in place, fantastic, because land registry doesn't usually go back that far in relation to saying what it was bought for. So as long as there's proof, that's fine. But what I would probably suggest is the value in the work that's been done since ownership may have trumped any acquisitional claim anyway. And what I mean by that is, we just use a scenario where a property was bought in the 80s for 150,000 and is now worth 400,000. Any claim historically will be on that 150,000. Whereas if, say, 200 grand's worth of work has been done to that property since ownership, there's probably more value in that work than there is acquisitional. So whilst pre-14 stuff is more simple to put through because it's not subject to the legislation changes, we are still sometimes hampered by the fact that property back in the 80s was worth a darn sight less than it is now. So it's one of those. We probably take a look at what's been done at the property in addition to the acquisitional, because that may be where more of the value lies.
Great. Thank you, Nathan, so much for your time. I think everybody that has been on have a few things, and we'll be walking around their pharmacy tomorrow, looking at their heaters, etc., and seeing what they need to give you a call about. Sorry, let me just see. There's one final. Yeah, just somebody asking for your details, so that's absolutely fine. I will send those through tomorrow. And again, like I said, if any of our attendees do have any other questions, just use the events at npa.co.uk, and then we will pass your details through to CATAX. Okay, once again, thank you for your time, Nathan, and thank you everybody for joining us this evening. Right, take care.
Thank you.
Bye.
Bye all. Thanks. Bye.